Austin, today we get to talk about that greatest of all U.S. government acronym, IRMAA, the Medicare surcharges in essence. And we're going to focus on what Medicare is and why we have a surcharge to begin with, how that surcharge is calculated, some of the ramifications for financial planning, and how we might be able to avoid some of those surcharges or keep them down, all in today.
You know, Spencer, as we think about IRMAA, it's maybe one of the most recognized by folks that are receiving Medicare, and maybe one of the most hated government acronyms, especially for folks that are receiving Medicare. So as we look at Medicare, its original parts, it was signed into law in 1965. There's several parts. You can go back and look at our interviews with Bernard Health. They'll walk you through the different parts of Medicare in much greater depth. But the reality is, if we looked at last year's trustees report for Medicare, and it looks at data from 2022, Medicare had total expenditures of about $890 billion against income of $988 billion. So it's bringing in more income than it's going out, but that's not always going to be the case. There's going to be a couple years in the future where the projection is that the income that comes in is exceeding the expenditures that go out. And so when we think about how Medicare gets its revenue, it comes from a couple different places. One, it comes from payroll tax. 2.9% of all of our income goes to pay for Medicare. And so if you've got a whole lot of people working and they're making good money, then Medicare's going to be doing well.
That's our earned income, right?
That's earned income. Okay. Yep. And then if you're a high income earner, there's an additional 0.9% of tax if you're above $200,000 for singles, above $250,000 for married filing jointly. So just a nice little bonus that if you make a lot of money, you get to pay more to Medicare. And then if you look at the actual charges for Medicare Part B insurance, there's a little bit of revenue that's generated from Medicare that comes from that, about $130 billion. And so that's about $174 per beneficiary. So if you're receiving Medicare, the baseline cost for you is about $174. So again, that comes out to about $130 billion versus what people pay in from the taxation on their income. It's about $350 billion. So there's a significant amount of revenue that comes from the folks that are currently working. And then the rest is the general fund of the Treasury. So we'll get into this, but those are essentially funds that are shifted from the Treasury from one pocket of the government to another pocket of the government. As we think about that last piece of income, there's a little bit, only about 8% of the beneficiaries that receive Medicare are actually going to be taxed in that surcharge. Now, here's where things get really fun. The federal government doesn't think about it as a surcharge. They think that, you've got a premium. The entire premium bill for Medicare for Part B is 100% of that bill. The government says, well, if you don't go above a certain income threshold, then you're only responsible for 25%. So they're giving you a premium discount of 75%. So every time you surpass a Medicare surcharge threshold, it's really not a surcharge that's being added. They're just reducing the benefit that they're giving you. That's the way the government thinks about it, is you're getting a reduction of your premium, and so they're just taking it back because you make too much money.
Wow. So if the average cost for Medicare is something like $700, we only pay $175 of it for Part B. They subsidize the rest. But if we make too much money, they claw it back.
That's right.
Even though we already paid for the benefit over time.
Well, you kind of paid for the benefit.
Okay.
You paid for the benefit of the people that were receiving the benefit at the time.
So we don't know if I got the benefit until later on when we diagnose whether I make too much money.
Exactly. And here's kind of part of that problem is when Medicare first came into existence in the mid-60s, from then till about the mid-80s, early 90s, there were about 3.5 to 4 people paying into Medicare at that time. And so when we think about the trust funds being funded, well, if you've got 4 people paying in per beneficiary, you're going to get an inflated amount. So the government at that time, and this is the same thing with the Social Security Trust Fund, they didn't actually sock that money away. They just shifted the money to other parts of the government that needed money. So Department of Energy, Department of Defense, when they are running significant deficits, they just say, well, Medicare and Social Security are running a surplus, so we'll just use those funds. And so now what's happening is it's actually written into the Social Security law That's why there could be a benefit cut, is they can't pay out higher benefits than they receive in income. We're not talking about Social Security today, but it's a similar thing with Medicare. Well, if we're exceeding expectations, if the expenditures go out faster, they're not taking money from DOD and DOE or education. They're saying it's time to up that premium, time to up that amount that the consumer has to pay, or you have to increase the taxation on current employees working. So yeah, you did pay in, but you paid in for those earlier beneficiaries that that now no longer may be receiving that benefit.
Gotcha.
So the way that Medicare surcharges, and Medicare just in general, is calculated is every September, there's an actuarial calculation that looks forward and says, okay, what has been our cost for this last year? What are we projecting it out to be for this next year? So 2024, 100% of the premium, like you were saying, is $700. If you don't exceed any of those surcharge thresholds, based on your 2022 modified adjusted gross income, then again, what you're paying is about $175. But every surcharge bracket that you increase, you are then liable for 35% after that first one. So not a big punitive jump, but there's a little bit of a jump. Well, then the next bracket is 50%. Ooh. The next one after that is 65, the next one 80. You're only ever gonna cross the 85%. So the government's always gonna cover at least 15%, but you're gonna be more liable the more brackets that you go up. So currently, no beneficiary is responsible for paying all of their Medicare Part B. So nice little benefit that you did get for paying in. Okay. So how do we know if someone is going to be charged a surcharge? Well, you can go back and look at how we calculate these. We did a video on this before, but the reality is it's going to be based on your modified adjusted gross income from 2 years prior. And so for 2024, your determinant, if you have a IRMAA surcharge, is based on your 2022 modified adjusted gross income. Now, for the IRMAA surcharge, modified adjusted gross income is your adjusted gross income plus municipal bond income. Modified adjusted gross income is not the same for other pieces, but for Medicare surcharges, it's your AGI plus muni bonds. So if you've got a non-qualified account with municipal bonds, we want to make sure that as we're doing our planning, we're calculating that in to make sure that we're not exceeding too much of that. All right, so let's look at these two examples here, just baseline examples. If you've got a single filer, you've got $100,000 of adjusted gross income and no municipal bond income. So your 100 is below 103, you're fine. You're just gonna be paying $175 a month, $174.70. However, if you've got $100,000 and you have municipal bonds that maybe, let's say, pay out $5,000 a year of interest, well, now you've got that $100,000 of AGI plus the $5,000 of municipal bond income. Well, if the threshold is 103, you've surpassed that threshold by $2,000. That's a really expensive $2,000 that you've crossed over. And so those surcharges are adding about $70 every month for that filer. And so you have another $993 for your Medicare surcharges between Part B and then Part D, you've got a $13 surcharge. So total is about $83 a month actually.
So if I'm getting this straight, we've got a surcharge for Part B, Part D, they total to $993, basically. Yeah. So that municipal bond income, we're thinking, hey, this is great. We're not being taxed on this at all. We got $5,000 of income. It goes $2,000 above that surcharge threshold. So that $2,000 of tax-free income costs us $993 in surcharges, or about a tax rate of 50%.
Yeah.
So sneaky kind of shadow tax that we're just not really aware of.
Right, right. Well, and if you think about this, if you're not receiving Social Security, then you have to pay out of your pocket for that Medicare Part B. And so if you still aren't receiving, so let's say in 2022, you're 62 years old, you have that 105, you've got that $2,000 that you thought was great, and normally it has been fine, but now you're starting to get Medicare, or let's say you're 63, now you're getting Medicare. Well, now if you're paying out of pocket and you're not taking Social Security, you've got now to find another $1,000 a year to where you can afford those surcharges. So it really is sneaky to think it was a benefit at some point. Maybe now it's not a benefit anymore. And again, we kind of crafted that scenario where it's really punitive, But that's the reality, is IRMAA is a cliff. It's not graduated. If you go $1 past that threshold, you're liable for that surcharge in 2 years.
So if you're $500 over, it's even worse. It's a 200% tax because you have $993 of tax against you or surcharge against you for just $500 of extra income. Right. So that's a spike.
Yeah, absolutely. And this is where we really want to start thinking about tax planning and say, we don't want to get as close as we can to the IRMAA surcharge threshold. We want to pull it back, partly because, again, right now in 2024, we don't know where the brackets for 2023 end until September. And so we're really trying to do some due diligence to say, okay, where do we think the end point is going to be? And then we pull it back to make sure that we give some space just in case there are some of those moving pieces that we weren't expecting in terms of either additional income or maybe a municipal bond income that pays out a little bit higher. So we're really trying to protect clients as we think about projecting out to IRMAA, knowing, okay, what's the most likely threshold, and then saying, let's bring that target back several $1,000s to give some of that space.
Well, and this is only the first threshold, which is only a 10% increase. When we go to the second threshold, it's time and a half. It's 15%, right? So we're not just talking about for a married filing joint couple $2,000. We're talking about $3,000 for that next level up.
Right. Yeah, exactly. If you are you're getting close to retirement, and you have had high income, let's say you're planning to retire at 67, and you've got high income and you've been able to pay, maybe you're deferring taking Medicare because you've got employer-sponsored health insurance. Right. So one of the things that you can do is when you retire, you can file Form 44 with Social Security Administration to say, hey, my income that has been here, I'm retiring, I'm not going to have that kind of income anymore. So please don't punish me for these surcharges. So let's say you have $250,000, $300,000 that pushes you into that first, maybe even that second bracket of IRMAA surcharges. If you don't have that same level of income, then oftentimes Social Security will say, okay, I see that you've retired, then we're not going to punish you going forward for those surcharges. So all you'd have to do, again, is file Social Security Form 44 with the Social Security Administration once you do retire.
And it's not just retirement. There are other kind of life-changing events that you can note there, if I understand right.
Yeah, I think there are as well. Things like death or other pieces, you'd have to look at Social Security Form 44 to really find those details. But yes, there are. It's typically, with a lot of those things, big life-changing experiences. So Spencer, let's walk through just a couple examples, hypothetical examples of where we could really think about financial planning for clients if they are close to that Medicare surcharge threshold. So in this first example, we've got Walter and Wendy. They're 63 years old. They're going to start Medicare in 2 years. They have pension resources, IRA distributions to cover their living expenses. Their modified adjusted gross income is typically below that first IRMAA threshold by about $15,000. And they've got about $2 million in their IRAs and no other non-qualified resources. So they're taking those distributions to have living expenses. Well, this year they want to remodel their home and they're expecting that it's going to cost $20,000. So if you're thinking about this, if they're 15 under and they want to take a distribution for 20, it's going to push them over and push them over just enough to where it's not really, it's going to be pretty punitive. And so when we think about this situation, if they've got other things that they're wanting to do in the next couple of years, let's say they want to buy a car or take a family vacation, we want to think, okay, if we're going to cross over that first threshold, maybe let's go ahead and take some additional distributions, push up into that, as high into that threshold as they feel comfortable pushing in, so that that cliff that they've just fallen off doesn't hurt as bad. And so we don't want to try to maybe cross into a higher tax bracket, but how do we push up that distribution as high as we can to where maybe they're taking $40,000, $50,000 of distribution rather than just 20, so that that $1,000 or $2,000 for them of additional premiums doesn't hurt as bad as if they were just crossing that threshold by about $5,000.
That makes sense, and I guess they could also take from a non-qualified account to take a distribution, and maybe if they could do so in a way that they didn't have a ton of capital gains, then they still stay below that threshold.
Right. So that's kind of that second scenario here, is let's say that Walter and Wendy, instead of having $2 million in an IRA, they have $1 million in an IRA, $500,000 in a non-qualified, and $500,000 in a Roth. We could look at that and say, okay, are there tremendous gains in that non-qualified account that are going to push you above that threshold? If so, what does the Roth look like? Has it been open 5 years? Can you take a distribution of that Roth IRA? If so, that might be a place where we say, let's pull that Roth IRA lever so that we're not pushing you above that surcharge threshold. So again, we're thinking about this in a holistic picture for these clients because they need the funds, but we don't want to have a punitive distribution of funds over and above what's necessary.
Well, what if we have a scenario where we have a lot of gain in that IRA? They weren't subject to it last year, but we're projecting that they will be subject to it, and it might just be a couple $1,000s above and beyond that IRMAA for this next year because, again, their IRA, their RMD is much higher now because they had some gains. What do we do in that circumstance? Is there a way to avoid it there?
Yeah, so one way that you could think about it, if clients are over 70 and a half and they're charitably inclined, I guess if you're taking an RMD, you have to, you're over 70 and a half. So you could make a qualified charitable distribution. What that's going to do is, let's say you've got a $15,000, or let's say next year it's $30,000 that's projected as your required minimum distribution. Well, if you're trying to get back below that threshold, maybe it's a $20,000 qualified charitable distribution that gets you back below that threshold. Because again, what a QCD does is it says, okay, here's what's that taxable distribution. Well, actually, it's going straight to charity. So instead of a $30,000, you take 20, push it to the charity. That doesn't include in your taxable income. So it really only looks like 10,000 is pushed out. So that's one way that you could do it. If you just need the funds and need that RMD, then we say, okay, what does it look like maybe to make a Roth conversion? Again, we don't want to just cross barely into that place. We want to think, okay, now what other opportunities do you have to maybe push a little bit higher so that that penalty, that additional surcharge, isn't as punitive in terms of how it feels. So Spencer, as we think about IRMAA, income-related Medicare surcharges, there's a lot of scenarios. And so really what we want to say is take everything that you've seen and heard today with a grain of salt, take it to your financial advisor, talk with them about how does IRMAA affect your financial plan. Do you have municipal bond income that you haven't been factoring into your modified adjusted gross income calculation? Hopefully, clients, this was helpful for you. Feel free to come to us with any questions that you have about IRMAA. And with that, we'll see you again next time. If you like these financial planning videos, please share with a friend. And if you have questions, go to our website at SeriousRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SeriousRetirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.